Hey guys, I wanted to make a quick video today on if you can afford to actually get rid of clients and how to do that in an affordable way where you're basically not really losing money. So now there's a few things to do that. I mean, number one, no one really likes it to lose client, right? So from a revenue perspective, we think, hey, we lose clients, we're losing revenue, but not necessarily, right? Because some of these clients may be pains and more than one particular area. Okay, so what I have here is called the Firm Client Analysis Report, and by the way, I'll link to this. You can download, it's totally free. You can go through exactly all the things that I'm going to be showing you today step by step. The purpose of this video is to kind of show you how to go about doing this. So if you're running an accounting firm, if you're a tax pro, bookkeeper, outsourced CFO, this is a great exercise to do on your clients to figure out the best way to approach these particular clients, right? And now that it's kind of halfway into the year, you have to figure out, well, am I going to continue to service these clients? Do I want to turn them over? Do I want to call them out, via a call out sale? Lots of different ways to go about doing this. So what I have here is I have two sheets, and really I have a list of 20 clients here, 20 of these clients that we're going to go through. And it's pretty simple, actually. We have the customer name, we have the total sales, we have the score, and I'll show you how this is a score of 1 to 10, and I'll show you how this is divided on the second sheet here. The cost of service, right? So let's just go through example. Harmony Haven Crafts, right? So they have 400,000 in total sales or 400,000 in revenue for our accounting firm, and it costs us about $100,000 a year to serve them, but we get $300,000 in gross profit for this particular client, representing about a 75% gross profit margin, which is pretty good. And it takes our team about 1,000 hours to service these particular clients. And these are, hypothetical clients. I'm not giving out real client information here. And so very profitable, in this case, $300,000 for this particular client. The last, so basically these two columns here, profitable, not profitable, these are just kind of repeats. I just wanted to break out the profitable versus the not profitable so I can go through a little exercise for you in just a couple minutes here. And then the last column is the call hours saved, right? So this represents how many hours where our team takes to service these clients. And if we were to get rid of these clients, how much would it actually free up for our firm, right? So another part of this is not just being able to get rid of these clients because you may be losing money on these particular clients, and like in this case, we're losing a significant amount of revenue, but we're also going to be freeing up time by getting rid of these clients, right? But all clients are not created equal, right? So I want to go into some nuances, and we're going to look at it from a qualitative and a quantitative perspective, right? So left brain, right brain, kind of look at this. Okay, so let's dig in. Now, the first thing I want to cover here is, and again, you can download this sheet here. Make sure you just make a copy of it, enter your own firm name, do whatever you want with it. And what you can do here, so the first thing is you're gonna go to the sheet number 2, and this is where we set up our rating criteria, right? So pretty simple. We're asking 4 questions essentially, and we're giving a rating. So the first is, is a client easy to work with on a scale of 1 to 3, with 1 being kind of a pain to work with, 3 being a real pleasure to work with? Do they pay bills on time? Again, 1 to 3. 1 being they are continuously late with their bills, and 3 being they're paying on time. 3, do they refer clients? 1, they don't refer clients. 3, they're really great at referring clients. And this is one of the most underrated criteria parts for this, and I'm going to go through this in detail in a moment. And do you like them as people? And this is binary. It's 0 1. It's kind of like that gut check feeling. Hey, do I like, if I were to ask you, hey, look, yes or no, do you like them? It's kind of like that, right? It's kind of like your gut check, and only you as the firm owner would know that, all right? So, and then we basically go through, so here's a client list again, 20 of these clients here, and we're giving them a score, right? So the first one, we have the Harmony Haven Crafts. The ease is 3. So they're really easy to work with. They pay us on time. They get a 3 for that. The referrals, they're not really great with referrals, which is too bad. But we like them in general, right? So they get a total score of 8, which is pretty good. All right. And so you're going to basically do the same thing for each of these here. And let's just take another quick little example. Let's look at one with a really low score, so a 3, right? So that's really low. So this is Crystal Cove Jewelry. And are they easy to work with? No. Do they pay on time? No. Do they give us referrals? No. Do we like them? No. So they get a 3. This is pretty much the lowest score you can possibly get, okay? But suppose we're making a ton of money from them, but we really don't like them. So this is one thing, and we're going to go to some gray areas, and you're going to learn how to handle this. Okay, so let's dig into that. Now that we've had this, so you can basically list your customers, right? And again, you're going to go through each of the customers. And like I said, this is more of a subjective thing that you can actually invite your team in to do, if you have staff that you want to kind of go through and get like a better picture of it. If you're a solo practitioner, obviously this is a lot easier to do by yourself. Okay, so once you have this, you have your totals here. Now you're ready to kind of go through sheet 1 where we can kind of go through this exercise. So as I mentioned here, we have the customer list. And the way I actually sorted this by the gross profit margin, right? So the highest margin versus the lowest profit margins, right? So all of these are in the black. These guys are in the red here, all right? So the way that we're going to approach this is, so bottom line is the folks that are on the top here that are profitable, round 1, we're going to keep all of them, right? We're not going to make any adjustments. Now, in a couple cases, like for example here, Crystal Cove Jewelry, remember these guys? They got a 3. So we really don't like working with them. They pay us late. They don't give us referrals. Remember, this one here in Crystal Cove, right? They're hard to work with. They pay us late. They don't give us referrals, and we really don't like those guys. However, they are profitable, right? So we're getting about a 38% profit margin. Now, what is the right profit margin for your firm? I actually have another video that I'll share at the end here where you can actually go through this exercise at your firm. Let's just say if your gross profit margin is about 40%, so they're right in the ballpark, right? So it's like we have a decent margin. We're making about $72,000 a year from this client, but they're just a pain to work with. So we're going to leave these guys alone, right? These guys are all in the black, but we might want to revisit this one later. So we're going to go through this sort of like the lowest hanging fruit, and these are the ones that are basically literally costing us money, right? So all of these guys down here, they are negative gross profit margin, right? So we're losing, 13%, 15%, 20, 33. In this case, with Urban Oasis Spa, 106% negative gross profit margin, right? So now you may think this is ridiculous, but let's kind of look through this in more detail, right? So this is kind of like the bottom of our list. If we were looking at this client strictly from a from a gross profit margin point of view, it'd be super easy. It's like these guys are costing us what about $31,000 a year, right? And our team is taking up 600 hours of our team's time to service a client that we're losing $31,000, right? Why would we want to keep this client, right? Now here's the thing. If this was like a 3 in the score, it'd be an easy no-brainer, right? But it's a 9, right? So Urban Oasis Spa, let's look at these guys here. So we can see here that they're pretty easy to work with. They pay us on time, they give great referrals, and we like them in general, right? So we really like these guys. We're not really making any money, but remember when I said earlier, there's some factors that are going to be weighed pretty high, and referrals is one of those underrated parts that you have to really consider, because one way to look at this is, well, sure, we're losing $31,000, but if they're one of our top referrals, so one way we can look at this is how much in referrals did we actually get from these guys? Now, I don't have that column. I could have easily, I wanted to keep this super simple, but you can add another column here, maybe called referral dollars. And let's just say in this case, if Urban Oasis Spa has referred us, let's just say for simplicity's sake, let's just say $31,000 in referrals, they've effectively paid for themselves. So even though we're technically losing money, but they referred us a client or clients that's basically paying for that particular loss. So we're basically breaking even on that. It's kind of fuzzy when you think about it, because it's on paper it's a loss, but then again it's from a customer acquisition perspective, they brought in another client, right? So that's one way to think about it. So now we're like, all right, well, okay, Mark, so are you saying keep this client or not? Well, if we know that so my rule of thumb is, if I can verify that they have bought us in over $31,000 worth of referrals, and I can see that they seem to be consistent with referrals, then they may be, let's just say, a cheap customer acquisition source, right? Because as long as we are keeping them, they can refer us more. Now, that's something you'll closely want to watch on a regular basis. Now, the other part of this is, well, that's all fine and dandy. Sure, they're referring customers, right? I mean, now, let's just say if they referred these two, right, and they basically referred the top two customers, basically representing about $650,000 worth of revenue, be a no-brainer, right? So this is basically kind of like our marketing source, right? Forget SEO and paid ads. Referrals can be some of the best customer acquisition sources. However, like I said, I wanted to keep it simple. Let's just say they're basically breaking even on the referrals. So the other thing about this is, at the end of the day, we are still servicing this customer, right? At the end of the day, we are still using 600 hours of our firm's time to service. So now we have to look at it from an opportunity cost perspective. Well, if we were to keep this client, what could we be doing with these 600 hours, right? Let's assume here, for grins and giggles, the average hourly rate for our firm is about $100 an hour, right? So if that is the number, then we really have to think about how this is factoring in, right? So 600 hours, that's a lot of hours. Could we be using those 600 hours to go after another Harmony Haven or another Bright Beacon where we're getting 75 or 70% gross profit margin, right? And particularly if Harmony or Bright or one of these top customers, they are also giving us referrals, that's the best possible situation. So really what we're looking for, and I'll go on this, I'm going to kind of end with this in a moment, but we're not just looking at top gross margin, we're also looking at folks that are the top scores, right? So if we look at something like, let's just see something with so let's just say Bliss, actually I think, let's go through one where it's actually profitable here. Let's use, so Blissful Brews Coffee House, right? They got a score. It's a perfect score of 10, right? We love these guys. Awesome, easy to work with, pay on time, give us great referrals, and we really like them, right? So they got a perfect 10. However, the the profit margin is a little lower than we would want, right? So we want to, let's just say our firm wants about a 40% gross profit margin and about 31%. Not horrible, right? And there's ways, and I'll go into this in another video on how to increase that profit margin, right? You can do that through a number of ways. Pricing is one of those. However, in this particular case, we know that, okay, this is a pretty decent client for us, right? So, and we use about 1,300 hours, right? So if we were to give up some of these bad customers and devote our hours to clients that are getting, a higher profit margin, then we can basically go after more clients like this, and it solves the other problem of, well, if this happens to be a great referrer, right? So we're also looking at the quality of referrals. Well, if Blissful Brews Coffee House is giving us some great referees, then we know that we want more clients like these, right? And then we don't have to work with this weird situation where, sure, well, the only reason we're keeping Urban Oasis Spa on board is like a cheap customer acquisition source. We can actually go to a client like this that's giving us referees. However, they're actually profitable from a gross margin percentage. Hopefully that makes sense, okay? So like I said, that's one other way to look at it. So this is, like I said, a way on how to kind of like go through these, get a better idea of how you want to go about figuring out these clients. So this is pretty much it in a nutshell. And when you go about this, the easiest thing you can do is, like I said, basically you can get rid of these lower hanging fruit clients. And basically these, even though, see, in the way that I broke it down here, even though if we were to get rid of these lower hanging fruit clients, that represents about $682,000 worth of revenue. However, it is going, this. So like I said in the beginning, from a revenue perspective, it looks great, but these guys are actually costing us more than they are worth. Okay, so and we can go into this in another video, but basically, if you're looking to get your firm acquired, or you're looking for like an exit strategy, sure, revenue is attractive, right? We're looking at, maybe if an acquirer is looking at a $2 million firm, it looks great on paper, but when they go through the numbers, they're looking at, well, hey, you have a lot of unprofitable clients here, right? So this is an excellent exercise to go through also before potential acquisition as well. So we can see here, like I said, $682,000 of these clients here. So now watch this. So if our total sales or total revenue is about $3 million, and then we have the, and then basically the profit per client is about $900,000, right? Watch this. So if we were to get rid of these clients here, the lower hanging fruit, so instead of 3 million and the 900,000, so the total revenue goes down 2.3 million, but the profit per client goes significantly up. Okay, so this is one really big benefit of that, right? Because you have to understand this in terms of the gross profit, and I'm gonna just kind of go through this again here. The other thing is, so our gross profit margin, so remember I was saying, like, it really depends on what you're comfortable with in terms of your gross profit margin. If you have a 19% gross profit margin, that's not really that good, okay? But if we were to get rid of those bad clients, then that 19% goes up to 37%, representing a lot closer to that 40% that we can be comfortable with, okay? So, like I said, I wanted to kind of go through this exercise to kind of show you how to go about thinking about this. And the last thing I'll do is, so I made an entirely another video on how to figure out what your gross profit margin, or basically what your best margin could be, and I'll share that. So this is the Firm Capacity Planner version 1.01 that I created. You enter your firm margin or whatever you want your margin to be, and it'll reverse engineer your entire client base. How much you're paying your bookkeepers, your managers, your accountants, all your staff, the hourly rate, how you're going to price your actual services, your services mix. It goes into a lot of detail. This is totally free too. I'll go ahead and link to that. And you can basically see this in the next video. So thanks again, and I'll see you on the next video.